Good afternoon, everyone. Welcome to this SOFA session. As promised, we will talk about the impact of the COVID-19 pandemic and the Russia-Ukraine war on the credit risk management aspects in the banking industry. To be honest, this is a very big topic and we cannot cover all aspects. And so let's focus on the course itself, and we will discuss mainly the impact of the pandemic and the war on the credit risk modeling aspects. A recent study done by Deloitte revealed that the impact of the COVID-19 pandemic on credit risk is not as significantly high as people expected in the beginning of the pandemic. In terms of default rate, we do not observe a significantly higher default rate as compared to before 2020, for example. However, we do have observed an increasing number of rating downgrades of the companies, especially small, medium-sized entities. In the banking side, we have observed an increasing level of provisions because of the fact that now the provisions are calculated based on the so-called ECL, forward-looking measure imposed by the IFRS 9 requirements. The reason why the provisions are much higher than pre-pandemic period has twofold. First of all, ECL, expected credit loss, has a procyclical feature. That means when we are already in an economic downturn, it adds additional stress and more strict requirements to the banks to hold even more capital as provisions. And secondly, there are two types of ECLs, if you recall from the course. ECL over the following 12 months and ECL over the lifetime of the exposure. And there is the so-called significant increase in credit risk trigger, the so-called SICR trigger. Once this trigger is hit, the exposure will have to be moved from the ECL for the coming 12 months to the ECL over the lifetime of the exposure. Hence, a significant increase in the provision value. As you can imagine, it is important to have a proper definition of this SICR trigger so that a bank will not experience a massive migration from the ECL over the coming 12 months to the ECL over the lifetime of the exposure. And the regulation also noticed this and already took timely action. For example, ECB already published the mitigating regulatory requirements to avoid excessive procyclical assumptions in the calculation of ECLs, including the definition of this SICR trigger. Another potential impact of the pandemic to the credit risk modeling is in the data used. A regulatory requirement is that the historical data used for credit risk modeling should be representative to the future behavior of the portfolio. Whether that is still the case now is questionable. The pandemic has caused various changes in the environments, legal environments, economic environments. Hence, it's now questionable whether the current historical data used in the credit risk models are still representative enough or not. Now, due to the lack of representative historical data, experts' opinion will become an important input to the credit risk models. A third observation is that due to the government intervention, moneyness policy or regulatory policy, the relation between macroeconomic factors and the probability of default are distorted. Hence, it is important for banks to investigate and review the relation embedded in the model between these macroeconomic factors and the PD. For the same reason, EBA, the European Bank Association, also requires that the historical period in which the historical data are included in the dataset for modeling should reflect um, the likely range of variability of the default rates, and this variability might have changed after the pandemic, and thus is subject to investigation and review. Another challenge that we now observe in the credit risk models as a consequence of the pandemic is that the sector definition or the segments of the sectors in the current credit risk models might not be appropriate. For example, certain sectors are more vulnerable to COVID pandemic than other sectors, but current models might not distinguish these sectors as such. For the AIRB models, the impact is mainly observed in the margin of conservatism estimation, mainly because of the representativeness in the historical data. In other words, the validity of the existing credit risk models is challenged by the pandemic. Now let's spend a few words in the credit implication of the Russia-Ukraine war. As we have already observed, this has imposed enormous stress to the global financial markets and the supply chain. With the sanctions imposed by the United States, European Union, and other countries against Russian individuals and Russian businesses, we can expect a severe deterioration in the creditworthiness of the Russian companies, and that impact will spill over to other countries as well. The complete impact in the credit risk is still to be unfold. However, we can already now refer to some analysis done by S&P, for example, to get a vision on the short-term impact and the long-term impact. Long-term impact is expected to be 2 to 4% increase in the average default rates in the US and major Western countries, and 4 to 9% increase in Russia. Also, they gave this impact analysis across different sectors, which shows that certain sectors are more vulnerable to this war, such as airlines, wholesale, and retail, because of the globalized nature of their supply chains. And in Russia in particular, the most vulnerable sectors are hotels, gaming, services, and business. And they expect that the PD of companies from those sectors will increase by about 1/3. Regarding the impact of the war on the credit risk modeling aspects, the same conclusions as what we discussed before still hold. That is, banks will need to revisit the validity of all kinds of model assumptions made due to the changed economic and legal environment. And also representativeness in the historical data, whether the relation between the main risk factors and the PD is distorted, whether the excessive procyclical assumptions are used in the calculation of the provisions. Feel free to give your own opinion and leave your comments in the discussion forum. And you can also find plenty of discussions online in YouTube. Yeah, that's all I have to share today. Thanks. Bye.